Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Sunday, December 3rd, 2023, and this is Blockhead Traders Weekly. In this week's episode, it is just myself, Sprocket888. We had a little bit of a scheduling change as far as recording goes, so Viper wasn't able to join us this week. And I thought I would take a dip into earnings risk management a little bit this week. So I am a big proponent of playing earnings and selling extended volatility. And there's several different ways when you do that you can kind of mitigate risk and control kind of the downside or max loss situations. And so I thought I'd take two upcoming examples of earnings this week that I intend to play and kind of slice and dice them a little bit live to show you different options that you have for kind of mitigating the risk. And risk is something where everybody is going to be a little bit different in their tolerances. And so there really is no right or wrong answer for everyone. There is a right and wrong answer for each person. And so in this week's episode, we are going to touch on some of those, different ways to look at it and different ways to consider that. So I call it, earnings with a safety net and without. And so depending on your risk tolerance, there are, how close do you want that safety net to be? But first, I want to mention our Discord, link in the description below. You can hop in there. It's free to join. You can say hello to myself, Viper, several other Blockhead traders. We'd be very interested to know what type of content you want to hear about and what type of trading you like to do. You also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can get this wherever you get your podcasts in an audio-only format, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And like I mentioned in the intro, we are going to focus on earnings and various risk mitigations that you can put in place when you play those earnings. Now, specifically, it's not generic earnings plays. We're going to look at volatility selling. And so there are quite a bit of back episodes that we have on the topic of earnings and volatility. It's the type of trading that I like to do the most is you take when volatility of a stock is extra extended and you sell that volatility. And the idea is you're expecting that volatility to contract and get less in the very near future, and then you buy back your position, closing it out. And the profit that you make is the extra premium from that higher volatility period. And then when that volatility shrinks and falls off, the premium becomes less, and so you buy it back for a cheaper amount. And it's a oscillating indicator because basically volatility kind of extends and contracts and extends and contracts. And so it's a cycle, and we're just looking for periods when we're kind of on an upswing where we go to sell that volatility, expecting a contraction. And this can be done all throughout the trading year. However, volatility is usually extra high going into an earnings announcement because volatility tends to indicate uncertainty. So if you think of it like insurance, I always draw a parallel to volatility and insurance and selling options premium to the insurance industry. So the higher the risk of big price movements, the more uncertain or unknown conditions, the higher that insurance premium is, because an options contract is really just kind of an insurance premium where the buyer of the option is the one that is purchasing the option for either speculation or protection of their investment. And the seller of the option is effectively like the insurance writer saying, hey, don't worry if things go terribly awry, I got your back. I'm going to buy these shares or sell these shares depending on which end of the contract that you're on. And the insurer, much like regular insurance, is betting that if he collects enough premium, the amount of times that he has to pay out to those people purchasing insurance premium from him is less than the premium that he collects. And that's really the premise of kind of option selling in a nutshell. And so with earnings coming up this week, I wanted to take a look at two particular stocks that I intend to trade earnings on. And I'm going to take you through how I've kind of selected these two. And then, normally I've done this before. I tell you, hey, these are the strikes I'm going to play. This is my move. But what I'm going to add this time is I'm going to add a little bit of dialogue about other protections that you can put on this particular earnings trade if you want to cap your max loss in some way, shape, or form. And so that's the added dimension that I'm going to talk about this time. Is I'll show you what I intend to trade, but then I'll go through a couple of scenarios that you as a trader might want to consider when you go to make these similar trades. Before I hop to the first stock, I want to give just a little bit of why did I decide to do this? Not only just because I think it's good to give variety of not just exactly what I do, but also some other things that other traders might do. But the reason I started looking at this was several weeks ago, I decided to try to start moving some of my trading into Interactive Brokers trading platform. Historically, I have been using TD Ameritrade, Thinkorswim. I did a year-end kind of evaluation on the fees that I was paying to TD Ameritrade for the style of trades that I was putting on. And I found a significant potential reduction in fees by switching to Interactive Brokers. Now, I'm not 100% into Interactive Brokers, and I'm not leaving TD Ameritrade 100%. But I am going to start to try to shift those trades, which were higher fee intensity in TD Ameritrade, to the Interactive Brokers platform. Now, the way that I did this is I didn't just do a mass exodus of TD Ameritrade, but I have a weekly drip fund that I drop a certain percentage of my weekly income into a trading account. And I build that up, week after week after week. It's constantly dripping in at a rate. And so several weeks ago, I shifted that drip from dripping into TD Ameritrade to dripping into Interactive Brokers. And Interactive Brokers doesn't have a significantly high cash position in there yet because it's still kind of building up from the drip, but it has enough for defined risk trades. And defined risk basically means when you take the trade, you know your max profit and you know your max loss. And that is typically the type of trading that you have to do when you are on a small account, where you don't have a lot of margin, or maybe you have no margin available to you, depending on how large the account is. And so you're looking for these trades that are a defined risk of a max loss of, say, $100, $200, $300, because that can fit within that small trading allotment that you have in that account. And so that's where this kind of came from. I wanted to start looking at trades that I can do in the Interactive Broker account while I'm kind of dripping and filling up, and I haven't quite reached a margin status. I haven't quite reached some of these things that will expand my options when it comes to trading strategies on Interactive Brokers yet. So let's jump into this, screening out the first plays that I had to show you, okay, how did I bubble up with the two earnings trades that I want to talk about today? And this is something that we have covered in the past, probably multiple times, but it never hurts to just touch on it relatively briefly. This is my earnings scanning that I do. The scanner, this is something you can replicate no matter who your broker actually is. This is in TD Ameritrade's Thinkorswim. I'm still getting used to the Interactive Brokers tools, so I haven't replicated this scanner in there, but I do intend to and film future episodes on that. But what I've got here is a closing price. So I'm looking for stocks that have a base price of at least $10. Much below that, it's not worth it. I don't set a limit to the top when I'm doing some of this because earnings are kind of everywhere. And then depending on the underlying price in the screener, I may or may not look at it. Volatility index. This is the spot volatility, the volatility at this exact moment. This has nothing to do with the historical range or ranking of that volatility, just what is the volatility at this exact moment. I typically find if the volatility is not at least 30% spot volatility, it's usually not worth my time, effort, energy, risk. So I don't like it. That's why I trim those off. IV percentile. This is where I could narrow down the range of IV percentile. Right now, this screener is wide open. So it just says, hey, anything. So I could effectively delete this, but I leave this in the criteria because sometimes I want to try to scan that. Now, this isn't going to return very many results. So I sort by IV percentile to then start looking from the highest percentile down. But usually this is where I'm looking for an extra extended percentile. And so I really only want to touch anything above 50%. If it's less than 50%, it's not enough extended for me to sell. if you go really, really low, you might consider buying the options that have very low volatility, but that's not the strategy I'm talking about here, and that is not a strategy that I normally use. Next is earnings. So this is saying, hey, in the next 8 days, do they have earnings? This is looking for what's upcoming with earnings, because when I'm playing earnings, I want to know what's happening really soon. So I don't place trades for earnings weeks, months, days in advance. I want to typically try to do one day, the day before earnings, maybe the day before, potentially the week before if I'm going to have a busy week and just enter in my order anyway. But the closer you get to the last moment to enter earnings is the ideal for me. Next is average volume. So really, I only want to do this on liquid, high volume stocks. And so I say over the past 5 days, who has at least 1 million shares of volume in a day. So I don't want to look at small volume. You get a lot of bad price fills, wide spreads. So I find typically 1 million. The higher we go on volume, the more liquid, the better the fills are, and the more appropriate they are. But 1 million is about my cutoff threshold. So right here, we've got the list that comes up. And flipping through, I sort this by IV percentile. And so the most extended ones are up here listed first. You can see CHWY is number 1 with a 91% IV percentile rank, a 94% spot volatility index, and a volume of 11 million. So this one is the first one that I want to talk about. So let's jump and look at CHWY. Looking at the chart, the first thing I'm going to do is I'm going to look at the chart to see where does this line up volatility-wise. I know it's at 91% volatility, but the couple things I want to look at is how has this stock reacted to earnings announcement in the past with respect to volatility, and where are we at with respect to volatility historically? And so the top part of this chart is the price action candles. I don't care as much about that. I do kind of look for a general trend here just to see what it's kind of looking like. And in this case, CHWY has kind of had this massive decline. It looks like we were going through some kind of consolidation down here. Relatively sideways, maybe a little bit on a gaining. You can see an all-time low here, or at least in the past 52 weeks, around 1653, kind of coming down and maybe making a higher low. So we might be moving a little bit on the upside from here, but that's really just kind of saying, is this thing tanking? Is it a skyrocket? Because a lot of times what I like to play the most is stocks that aren't going to go anywhere on earnings. So on earnings, I like to play both top and bottom selling, and I'll show you that. That's a strangle. And so I kind of like things not going anywhere. So right when I look after that, the other indicator I use is an RSI, which is a relative strength index. And I like to see this RSI somewhere in the middle-ish. This is not hard and fast rule, but I like to see something that's kind of in the middle, because that is also kind of an oscillating indicator where stocks typically go really high on RSI and they go low on RSI and high on RSI and low. And so a lot of times when you hit to the bottom range, you don't really know when it's going to pull out, but largely that RSI will start to increase, as you can see it did in CHWY in the past. Now, the more important thing that I'm looking at is this red and green Christmas indicator. And this is a plotting of the IV percentile of implied volatility. And the thing that I'm looking for is up here on the price chart, you'll see this red and blue. This is every earnings announcement. So here was an earnings announcement. 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 And look at the volatility that right below that, right? Cliff. Okay. Little drop. Now this one wasn't too big, but drop. Drop. Okay. So that is that contraction that I'm talking about. We want to sell premium before the earnings announcement. As soon as the earnings come out, volatility contracts and that price becomes lower, that premium becomes lower. You can buy it back, close out your positions. And so I like to see a very repetitive drop in volatility of a significant value going into it. Now, this is amazing. This is awesome, because from this less drop, you see building volatility, building volatility, building volatility. This graph switches to green when it is over 50% volatility for the year. And remember, that's what I say. I like to look for extended volatility. This can go from 0 to 100. 100 means we are the highest in volatility that we have ever been in the past year. So we're not quite there yet. We're at 90 some percent, 93, 90 percentile here. So I am looking for a massive volatility contraction post this earnings. Whether the stock is going to go up, go down, don't know. All I care about is, does volatility contract? And so graphically, this is checking all of the boxes of my trade that I want to take. So now that I've identified the trade or the underlying that I want to take, I've confirmed from the chart that this does in fact meet all my criteria for checking out the option chain, checking out the premium, checking out the risk. Let's go to the option chain and I'll show you what I drill down here. So the first thing that I want to do is I wanted to check when the earnings announcement actually are for CHWY. And they happen to be on December 6th. So that is this week. And you can also note that in the percentile. So this is the IV percentile, the volatility of that particular option chain. Now, the week of earnings will be the most volatile because that's when the most is unknown. And so that's going to be options expiring on December 8th. That's this coming Friday. And you can see they have 168% volatility. And so the strikes that I want to trade are the ones of the week of earnings because I want the most volatile, the most likely to contract. That's where I want to play it. I have management abilities past there, which, we might roll. We'll talk about all that later. But the first strikes I look at are going to be the week of the earnings. And so we'll open up this option chain. Okay. Now, the first thing I'm going to do is I'm going to pick my strikes. And the strikes that I look to pick, because I'm going to play this on the top and the bottom side, because I'm going for, hey, we got a lot of extended volatility. I'm expecting this stock to stay within the expected move. If it stays within the expected move and volatility collapses, my strikes will be outside of where the expected move is. I will remain out of the money and be able to just kind of cash in whatever my play is. And so what I'm going to look at is for a 15 to 25 delta strike. And so we got this column here. This is the delta. We got our put side and the call side. And I'm going to scroll down here till I get to 15 to 25. And I'm going to look kind of at the premium and decide, where do I want to play this? For CHWY, the way that this option chain is looking, I'm going to probably go with this 22 delta strike, which is a $16 strike. So this is saying that after the earnings announcement, I am expecting CHWY to stay above $16 a share. Currently, CHWY is trading at $18.32. And so I'm going to click this leg to add this to my order. This is the bottom side. Now, as I scroll down, I want to take a top side. Again, I'm going to look for the 15 to 25 delta. Now, a lot of times when I play earnings, I will get a little more aggressive on the put side if we might be in an upward trend, things like that, versus aggressive on the call side. And the reason for that is stocks generally go up and to the right. Not always. We can go through periods of down. We can crash hard. A lot of times stocks take the stairs up and the elevator down, meaning your downside risk can be more violent in dropping off. Well, going up takes a lot more effort to build up. However, the risk profile, which we'll talk about how to mitigate some of this, but if you are not mitigating the risk through a known loss or a max loss scenario, your losses, if the stock were to rally, can be infinite if you are selling a naked call. On the put side, your max loss is basically capped at zero if the stock goes to zero, because if it goes bankrupt, that's as low as it can go. It can't go below there. So you do kind of have a defined max loss. But generally, I will play more aggressive on the put side than on the call side. So I took a 22 delta on the put side, but if I come down to see what am I going to take on the call side, I am probably on this one, probably going to look at maybe the 16 delta $23 strike. So I'm going to add that to my order. So notice this is a 16 delta. So that's farther out, closer to that 15 delta of my range. That's because I do not get as aggressive on the call side. So this right here is an order that is playing earnings without a safety net. So I said with a safety net and without a safety net. So let's take a look at the profit and loss potential of without a safety net. Now, Thinkorswim TD Ameritrade does a nice job at this. You can go to the risk profile section of the option chain, and it will plot out a nice chart here of what your P&L looks like over the price. Now, one of the things I'm going to change is this option expires on December 8th. So I want to get my shading equal to options expiration of December 8th. And so this gray shaded range is the 1 standard deviation expected move of CHWY. That for options expire there. You can see my strikes are outside of this expected move. They are really far out on the expected move on the high side. That is because the way the option chain happens to be pricing CHWY is they see a lot of risk to the upside. That means there's a lot of bullish sentiment on that upside, where that 16 delta is really kind of far out there. This has heavy call skew. This is atypical of a stock. A lot of times stock has heavy put skew on the options because most people use options for downside protection. When you see a underlying with a lot of call skew, meaning the call premium is very high, that usually means that you have a lot of speculators buying the options on the upside, speculating that we are going to rocket to the moon. So just keep that in mind. That is why I go by the deltas and not by a percentage move from the strikes. You might say, oh, well, if you went, down a few bucks from the current price on the put side, you might as well just go up a few bucks from the current price and keep that symmetrical. I do not do that. I go by the delta because the delta is the mathematical and statistical rating of, based on all of the volume, the purchases, and the creation of the options, where is the statistical probability of price movement. So I typically only will overlook at the 1 standard deviation. And what I mean by that is this gray box, I'm expecting it to stay within this gray box. And when I talk about risk, this is the without a safety net, because notice this P&L graph here. If I really ratchet out this price range, notice these drops have no end. They will have an end to the left because this is when the stock hits 0, your max loss. But like I said, remember on the high side, there is no limit to your loss. This will just keep going down and down and down and down and down. Is it unlikely that CHWY is going to go to $130 after earnings? Yes, of course that's unlikely. But if it did, you'd lose $11,000. So that's why I say this is without a safety net. And the other thing you can kind of throw into this particular chart are these things called price slices. So I threw a couple price slices in here. The center one right here, this is where CHWY is currently at. These next sort of slices are a 10% move. Okay, so if we move 10% from where we are now, this is where we fall. Now, I've got another one out here at negative 30% and plus 30%. Okay, so these next strikeout are a 30% move in the stock. Now, a 30% move to the upside, and I'll be right at my break even. So no big deal, right? I won't make any money, but I won't lose any money. A 30% move to the downside, and I'm going to be sitting at a loss of about $258. If I stay within these strikes, I will profit on this blue line of $77. And this is really where that risk mitigation really kind of comes in, is how confident are you? What is your feeling? What are the statistical probabilities of where this price is going to move? I'm comfortable with a 1 standard deviation. So as long as I keep my strikes, my break evens inside a 1 standard deviation move, I'm very happy. Maybe you want to be extra conservative. You can kind of come up here and you can say, well, give me a plus or minus 2 standard deviation move. Okay, so now here, this gray box has now expanded because this covers the 95% probability that the price will stay between $23 and on the bottom side, $14. Now, $14 is still a $93 loss, but that's your risk. Okay, this is where you can really start to see what your risk mitigation might be. One of the things that I always mention when I trade options unprotected is you have to be okay with assignment. That is one of my prerequisites. If I'm going to trade without a safety net, I must be okay to be assigned these shares, either short or long, because if you don't put a safety net on, that's effectively what you're saying. If we get a, drop down here, 2 standard deviation move to the downside, I will be outside of my $16 strike and I will be assigned, even though that option or that stock is trading at, say, $14.30, I will have to buy it for $16. That is what I am saying if I put this trade out there. Conversely, if we go above my $23 strike, I am okay buying or selling those shares to somebody for $23, no matter how high they go. So if we were to move up here to this plus 30%, and I would have to, get assigned, that assignment means I must sell 100 shares to whoever bought the option for me for $23. So even though they're at $23.80, I have to go to that individual and provide them 100 shares, which means if I don't have 100 shares, I got to go to the market to buy them to turn those over to that individual that purchased that option from me. So I would have to go buy the shares at $23.80 to sell them to that individual for $23. And I would be short 100 shares on the market at the $23 strike. And so if you are not comfortable with assignment and you do not want to hold those shares long, or you do not want to be short those shares, this is not the trade for you. What you need to do is you need to put protection legs on. So let's go back to the option chain. And what do I mean by protection leg? So let's start with the high side, because the high side is often where I would recommend that you put most of your protection, because that's where you have infinite loss. And so you need to decide, how much do you want to pay for insurance that you are not going to get flattened like a bug if this thing starts rallying 50, 60, 70%. So remember, we sold the 23. Now, your max loss is going to be the distance that you go from that strike. So if I come down and say, you know what, I want to protect this at 24. I want to buy an option at a $24 strike. That is an insurance that's going to cost you roughly 20 cents or $20 for that. Let's go back to that P&L chart. And this is what this does, okay? This means that once you hit that $24 strike, you're golden. You can't lose any more than that because you bought insurance at that $24 strike. Now, it costs you $20. So if we look at this here, remember this all represents 100 shares. You got to move the decimal over by 2. You're going to collect $77. Then you're going to pay $20 for protection, which means you're going to net just $57. And you can see that here in the P&L. So this blue line, if you stay within this range, you get $57. Now, if you suffer a giant, rally up here and you go to $26, your max loss is going to be $43. So in this case, you have capped your losses right here at the $24 strike. And the way that you calculate this is basically you're $1 wide. So that is $100. And then you collected 77. And so that flip or that difference is what your max loss is. So we got $43 here. Now let me take this protection leg away. So let's say at this $25 strike, your max loss is $43. If you don't buy that protection and you get to 25 here, your max loss is $124, 3x. So you see what we just did there? We mitigated the risk. So we took a 3x loss and we dropped it by a third, saying, okay, if I spend this $20 for protection, I can avoid a 4x or a 3x multiplier to the loss. So let's go ahead and add that protection back. And you can see, okay, now our max loss here is at $43. But that has cost us some of our premium. So without the protection, I'm going to collect $77. With that protection, I can only collect $57 because I've got to pay out for that insurance. So let's go back to the option chain, and because maybe you don't like this big slide down. Maybe you do not want to hold CHWY shares if we get really low. So we go back to the option chain and we'll go back up to the put side. And let's see. So we went with that, $1 out on there. So that would be a $15 strike for protection. So we'll put that one down here on the low side. That's going to cost $26. So let's look at the P&L chart here. Okay, we got our max loss cap. Now it's $69. So our max profit is just 31 and our max loss now is 69 on the top side and the bottom side because we had to spend money on this protection. So we got $77 here. We had to spend 20 for top side protection and 26 for bottom side protection. But, let's say that we don't want to spend that much. I'm going to switch this back to one standard deviation here because let's look at the option chain. One thing about option chain is the farther out you go, the faster off the premium drops. So the closer you are to the strike, the amount of drop in premium is not, it's good, but it's not falling off fast. You can see if we just go out just another dollar, we go down by 50%. So if I instead put the protection at $14, I only have to pay $11 for that versus $26 for $15. So let's change that 15 and say, okay, well, you know what? Let's go ahead and get a $14 protection. I've now lowered my cost of protection to $11 for that. Let's go to the call side and see if we can come out, So here we can also drop by almost 50%, not quite, but almost 50%, going out another dollar to 25. So let's go ahead and put that protection at 25. So we'll do that. And now let's see. So now we're buying both legs of protection for $25. Okay. Significantly less than just $1 more. Now what's our risk profile look like? Well, now we're collecting $52. Oh, that's good. And then our max loss here is $148. And this is where you're going to change, what is your risk tolerance? When do you want to cap your loss? Maybe $148 loss is too much for you on a particular trade. So maybe you want to play the downside a little bit tighter. And so maybe you want to bring this up to 15. Okay, so now our max loss on the downside is $63. On the top side, our max loss is $163, but this is the one standard deviation expected move. We switch this to 2 standard deviations, and you can see that even 2 standard deviation move to the top side is, still not hitting this big slide here. So maybe this is okay for you. And this is what I'm talking about when you're playing with what makes you comfortable. Maybe this confidence level is okay because you could drop down here. It's within the 2 standard deviation move. Maybe you want to take that leg protection on the downside. You're going to pay more for it. And maybe you're pretty confident that you're going to stay within here. So maybe you only want to get like hurricane insurance, right? So let's take this 25 and let's go out to 26. We've dropped our cost for that insurance even more. Now we've taken on more downside potential, so our max loss dramatically increases. But if you are really looking for just hurricane insurance, then maybe this is more appropriate. And now we're collecting a total of $41. Now, it's because you're giving up a lot for this downside protection. If we, again, take away both protections, you can see, 77. And so it's really deciding how much protection you want to take in for your risk tolerance. Now, when I take this trade, I tend to take it on I like to trade earnings to collect the maximum premium, and I only do this on shares where I am okay to be assigned. I occasionally will put protection on the top side. If this is a meme stock, CHWY is kind of in that category of a potential meme stock, like a GameStop or something like that, where Wall Street Bets gets involved. And this thing could really run to the upside. And so in rare cases, I will go ahead and put topside protection on. In this, I might be okay with $26 topside protection because that is still outside that 2 standard deviation move. I'm only giving up $10 for that protection of my 77 credit. So I'm still going to collect $67. So this is really going to protect me from like a 50% jump, things like that. However, in Chewy's case, I'm kind of okay without that protection, playing that naked because I'll be short. I will be looking for if we're really going to ramp up. Remember, this is like 1 week trade, so earnings come out almost the end of the week. If we rally 50% in a day, I'm going to look for a retracement back to a level. So I'm basically going to use margin. It's going to suck up my margin if we breach this strike because I'm going to be short shares. I make sure that my margin and my capital pool is enough to kind of shrink and grow based on things like this. So I personally tend to focus on the one standard deviation move. That's where the majority of this expected move will be. That gives me a significant buffer to the top and bottom side. I'm okay getting assigned Chewy shares. I think, Chewy is one of those companies. It's memey. It's got potential to rally. It's been very explosive. So if I end up getting long the shares, it's not the best thing in the world, but it's not terrible for me. And so when I play Chewy, I'm going to be looking at this particular strangle, taking that 22 delta put side and 16 delta, 15 delta call side, heading into earnings. All right, heading back to the next stock of earnings. Kind of going down the list, Dollar General, this is one 100% I would jump in and play. However, my portfolio, actually, I'm already long 100 shares of Dollar General from the last earnings announcement. I actually played earnings the last time on Dollar General. I'll put a link in that episode above. I ended up getting assigned 100 shares. Now, I've been selling calls against that. So technically, going into this earnings, I did sell a call against my shares. That is a low risk play because I own the shares. So if it rallies and they get called away from me, I get paid for my shares. I make sure my strike is above my cost delta or cost basis for it. But because I own the shares, I'm not going to be short the shares. I just won't have my shares anymore. And once I get assigned, that's the whole premise of wheeling out of something. I'll collect the premium on that call. It will be an elevated premium because right now Dollar General has a lot of call skew. There's a lot of speculation of a high side. So in that particular case, I'm already in that trade. So I'm not going to take Dollar General. Kind of scrolling down, I'm really just looking for things that jump out to me of companies I've recognized, companies I might want to play. GameStop is just not one that I like to mess with. It's too memey, it's too volatile. So I'm just going to kind of sidestep GameStop. So working my way down here, the one that jumped out to me was DocuSign. Now it's kind of far down here, and it's only really at a 45 percentile. But it is one that I do think I want to take for earnings, and I'll show you why. So we're going to go ahead and select that and send that over to my chart analysis. And so let's go ahead and bring up that chart analysis so I can speak to a little bit about what I really like about DocuSign. And so on DocuSign's case, again, we're really kind of looking at a very horizontal-ish movement or trading range. It's come down a long way from its COVID world of just banging up at just hundreds of dollars. That's this red line is this 200-day moving average. But the important point is look at these earnings announcement, okay? Look at the drop that comes after these earnings announcement. This is very high volatility contraction. And while I'm not extra extended at the moment, none of these previous earnings announcement of recent were really overextended. So all I'm really looking here for is a quick volatility contraction. We kind of were back here. The RSI is really at the top end of the range. And so this is one where I might be a little more comfortable getting aggressive on the call side or a little more aggressive because we're kind of at the top end of that RSI indicator. Remember on Chewy, we were not, right? And so I give a little bit more buffer because I really get nervous on the call side of equity because, man, anything can sometimes happen in that world. And so I picked this one out strictly because I noticed how much of a volatility contraction are consistently there from all of the previous earnings announcements. Now, the spot volatility is also pretty good as well, even if the percentile is not so high. So that also helped a little bit in my decision. But let's hop over to the option chain to take a look there as far as what we're dealing with, what we're seeing. And in the option chain, again, the earnings for DocuSign, they didn't mention, but they're December 7th. So they're the day before the end of the week. And so you can see that December 8th expiration has 123% implied volatility, and it drops off next week to 90. So, the week of expiration, these are the ones that I'm going to play. And I'm going to look down that delta column because I'm going to start at a 15 to 22 delta, or 15 to 25 delta. So I'm going to come down here and, I could come up to, let's go with a 40. Let's start with a 42 on the put side. This is a little aggressive. I might back this down. We'll see where the standard deviation lies, but this is a 24 delta, so we're close to the high side of my range. And then let's go down to the call side. Again, let's kind of bias. Like I said, I get a little nervous on the call side. Oh, where do I want to go from a premium standpoint? Let's go with this 19 delta. So if I drop the 19 delta in here, we got 53 and 42. So it's a little bit more aggressive on the call side than the other one. I took a 16 delta, but I also stepped up the aggressiveness on the put side, going from a 22 to a 24 delta, collecting $165 for this trade. So let's take a look at our P&L. So again, I've got a couple of strikes here. Let's go ahead and dial these outside ones to maybe the 20% mark. So I got this first one is where the stock is right now. These next yellow hash marks are plus minus 10%. And here we got a plus minus 20% move to see where everything falls. Again, this is naked. There's no protection. So this is without a safety net. And let's see, this is the gray here is my 1 standard deviation move. Let's move into a 2 standard deviation move. You can see that, okay, I've got my strikes here within 2 standard deviations, except on the put side. So maybe on the put side, I might want to put a little bit of insurance, depending on back to that risk tolerance of you. Do you get more scared that we're going to breach the high side? Do you get more scared we're going to breach the low side? How do you feel about being assigned? Are you okay if you have to buy shares at $42 if they drop all the way down to 38 because maybe you like the long-term trend of DocuSign and you'll go ahead and take that to maximize your premium collection of $165 and not put protection on there? Maybe you're a little scared on the high side. And you might want to try to put protection here at your break even, which is 54.63. So let's buy protection at 55 on the call side. So let's go back to the option chain and let's see if we want to buy protection at 55, how much do we have to spend for that? We got to spend $42 for that. What does that do for our P&L? Okay, so this gives us, it's big slope to the downside, but maybe if you're more risked of breaching to the upside, you're now collecting $123 and that's your max gain, and your max loss would be negative 77. So maybe that is a good trade-off for you, right? So if we say this 55 here, you're going to be losing about $77. If you don't buy that protection, that 55, you only be losing $43, right? So if you think you're going to make it up to 55, that protection really isn't maybe worth it if that's what you think, because you're going to be losing less money if you make it to 55 without that protection, because you're going to give up some of that premium you collect. You got to give up $42 for that protection. But if you go to, say, $60, your loss is going to be $526. And so if you had that protection ramping up to 60, you will stay steady at a $77 loss. So this really just goes back to that insurance. Where do you want your protection? Where are you comfortable with? You can change this protection. Maybe you want to buy protection on the downside. So here we went out $2. Let's go out $2 on the downside to go to $40 protection on the downside. Let's go back to the option chain, look for that $40 strike. Let's go ahead and buy that protection. But we're spending a lot of money here on protection. We're spending $42 for topside protection and $55 for downside protection. That's a total of $97. We're spending $97 out of our 165 credit. So when we look at that, okay, you got a little bit of, your max loss is going to be 132 top and bottom, but you're only collecting 68. Maybe this fits your risk tolerance. Maybe you think it's going to stay within this plus minus 10%. So if it does, you're going to profit $68, but you're taking that off chance that if you go outside your expectation, you'll still be comfortably protected. You'll still lose money, which is okay. Every trade, it's all about mitigating your losses. And this is something I have said in episodes past. Viper's also echoed it. The real difference between good traders and great traders is not where they get their gains. It's really how do they mitigate their losses. The more loss control that you have, the more of your big time winners you get to keep. And you'll see traders that seem to hit home run after home run. A lot of times that's probably because that's what they talk about. That's what they show. That's what they like to brag about. But in reality, they have lots of losers. It's just how do you control how much those losers pull from your big gainers? And so you got to look at this as capital preservation or mitigating your risk. And so it's really where you are comfortable with your strategy. Again, you can take and you can push this protection out even further to something that's going to cost a whole lot less to insure. So if we come out to $60 on the call side, we drop that protection cost to just $14. And, okay, that we've dropped the protection front. Now, if you get all the way out here, you're going to lose a whole lot more. But if you're pretty confident that you're going to stay within this range, then this is really that, oh my gosh, a tsunami is coming. There's no way I would have seen that. You're protecting against what I call more catastrophic occurrence versus if you tighten this up to maybe a 54 strike, this is where you're protecting against maybe not so much of a catastrophic event, but more probable as far as a high water mark. And all of that, it just goes back to what are you comfortable with? Are you comfortable with the risk of being assigned short these shares and playing this effectively naked, keeping that maximum $165? That is a question that I cannot answer for you, but hopefully this kind of shows you some of that ability that you have with the option chain to layer on different protections based on your risk tolerance. Like I said, I tend to put protection on the high side versus the low side. And maybe I want to put that protection here really close. So this is a great example of somewhere where you can add protection with no risk. So right here, if I tighten up my high side protection to 54, maybe I'm okay owning these DocuSign shares. So I'm like, you know what? If this thing nosedives down, I'm going to take the temporary hit. I'm going to be assigned those shares long. Yeah, it's going to stink, but I have a long-term thesis that DocuSign is going to come back. They might get shocked, briefly in the short term, whatever. Maybe I take this trade. But I don't want to get run over by a, moonshot going to the moon. So I put a protection in at $54. Now I'm going to spend $52 for this protection, but I'm going to collect $165 and look at my max loss. If I breach that, it's not a loss. I'm going to keep $13. So here I have used the premium from this collection risk-free. So this thing could go to $157 and I'll still make $13. So this is what I'm saying. You can, based on the premium, based on things, you can manipulate and change and really mold the protection and risk mitigation that meets your own tolerances. So this type of profile is kind of called a jade lizard, where you have no protection to the downside. You have protection to the upside, but your protection to the upside comes for free, which means you're still making a profit even if you breach your strikes. Sure, your max profit goes down. So from $165, I'm down to $113 here. So I've lowered my max profit potential. However, for my max loss on the high side, I've created a max loss only in the down direction. And if you're okay, assign the shares, it's really not a max loss because now you have the shares. You can collect dividend from DocuSign. You can get raw price appreciation. You have a lot of flexibility here. And all of this stuff is what goes into these decisions. And so it's not really ever a black and white recipe for constructing these trades. So that brings us to the end of this week's episode. I really hope you kind of enjoyed a little bit of that dialogue in consideration for how you might take these trades. What type of risk mitigations can you do? This is actually what I absolutely love about options trading is you can get very creative about how you craft your profit and loss curves, how you craft your risk profile. You can really get that to match your own tolerances. So like I said, I tend to go into that knowing that I'm okay with assignment. And there's really no, black and white answer to all of this because it's really dependent on you and your tolerances. Now, I have guidelines that take me into these things, right? Looking for that extended volatility. I 100% do that all the time. I'm looking for IV rank basically above 50%. Is that tried and true? No, because DocuSign was at 44. But the higher we get extended, the more of a interest I have in that particular trade. What strikes do I pick? Oh, I always tend to look at that 15 to 25 to start. I then tailor from there. Where does that line up on that P&L chart? I definitely look at that. How does that look on a 1 standard deviation move? How does that look on a 2 standard deviation move? How does the chart look? Where are the levels of support? Where are the levels of resistance? If I want to protect against maybe a upside move because I look at the chart and I say, wow, there's a decent probability that this thing might go off to the races. Maybe I don't put a topside trade on there. Or maybe if I do, maybe I add a layer of protection only to the top side. Reverse that. Maybe the chart looks very negative. Maybe there is a high risk of a strong downside move. So maybe I want to put some protection on the downside. Where do I put that protection on the downside or the upside? How much do I want to pay for that? That's really where you kind of get creative with all of the different strikes on the option chain, putting some of that stuff out there. Where do you feel comfortable for the premium you're collecting versus the premium that you're going to spend for that protection? How comfortable are you with assignment? Do you know what you're going to do if you're going to be short those shares through assignment on the high side? Do you know what you're going to do if you get assigned those shares to the downside and you're long those shares? All of this stuff really factors in. And so it's kind of this neat creativity way where you can combine a lot of things and almost pick your little building blocks out of the bucket to say, hey, I want to build a risk profile or a profit and loss profile that looks like blah, right? That is the magic of what you can do with these option chains. And we start with that fundamental extended volatility, sell that, looking for a contraction. That's my foundational thesis for an earnings trade. You could have a completely different thesis for the trade, but you could use these same tools to help mitigate your risks. Maybe you're buying straight shares and you want to purchase the options to mitigate some of the risk of the price movement on those shares. You can do that. But really the fundamental thing that you have to start understanding is where's your risk tolerance? How do you feel about the risk? What makes you comfortable? What helps you sleep at night? And that really is a personal thing. Hopefully talking through some of this can help you understand where that might mean for you. I'm sure if you listen to some of that and you're like, wow, oh my God, I would never do that. Is that guy crazy? Okay, that helps you figure out where your risk tolerance is. That could be different than my risk tolerance. And so understanding that risk tolerance as you read other people's trading moves is very, very important. So you can't just go out there and copy people's trades. Understand what's happening underneath their trades. What does that trade imply for you? Because someone else's risk tolerance might not match yours. You might copy their trade and you might get wrecked. And you might not like that because you weren't prepared to get wrecked because you didn't understand the risk that was involved in that particular trade. And maybe if you did, you wouldn't have taken it because it's outside of your comfort zone. And really that risk management, risk mitigation, and that risk tolerance of you really, really matters when it comes to trading. Well, as you explore your own risk mitigation. The year is winding down. I'm going to start summarizing some of my trades. I still have more to put on before the next quarter of earnings kicks off. We're kind of wrapping up the Q3 earnings season. Q4 is not that far off, where we'll start with the banks again. There's a lot happening out there in the market. The Santa Claus rally that is all people always talk about this time of year. Maybe it's underway right now. Maybe it's going to get even stronger. Maybe it's never going to appear, but that's up for the market to decide. Hopefully you have a strategy and you're having fun out there finding trades that are comfortable for you to take. So good luck out there. And remember, think outside the block.